welcome to Text 3701 and 3761, right? So in today's class, I'd like to do a bit more. I want to cover the homework question that we had from last week, gross income. Then let's see if we can also look at exemptions. So exemptions are probably a small topic for us at this point. Then let's have a look at deductions as well. We will probably not be able to do the deductions in detail, but at least introduce the learning unit so that by next week we are already looking at questions for those deductions that we're going to look at today. All right. So from last week's class, we're looking at the gross income definition, and we also touched on the specific inclusions, right? And maybe to answer Karabo's question again, she was asking about specific inclusions just before we started with the class. And when you look at our list of specific or rather special inclusions, some of them are leasehold improvements, lease premium, leasehold improvements. So yeah, whenever a lessor receives a lease premium or a leasehold improvement, that would be part of their gross income, owing to it being a special inclusion, right? Then I've been getting questions as well on section numbers. It seems in your facet class, the lecturer was touching on section numbers as well, right? So with section numbers, I would say as a priority, we need to know what the section numbers say, what the legislation is, all right? So for example, this gross income definition is in terms of, let me just add, section 1 of the Income Tax Act, all right? So the most important thing is understanding how it works, all right? Well, we need a total amount, cash or otherwise, received by or accrued to etc, right? But if you can remember, I would say by all means include the section numbers, right? But I guess the section numbers help you when you get questions. Sometimes the question would say, in terms of the gross income definition, section 1 of the Income Tax Act 58 of 1962, determine whether this amount to be gross income is defined, right? So if you know what section 1 talks about, then you'll be comfortable reading on those section numbers, right? Then when you look at the special inclusions, they also come with paragraphs. For example, the annuity is going to be paragraph A. Then alimony and maintenance, that's paragraph B. If I look at, say, leasehold improvements and lease premiums, that would be paragraph G as well as paragraph H, all right? So if you're not too comfortable with the section numbers, I would say focus on what the theory is. But if you can remember it, then by all means you can use it as part of your answer as well. The only danger to using section numbers, if you're not too sure about it, is that of saying, according to paragraph B, yet you're talking about paragraph G, right? That creates another difficulty altogether. How are we going to mark something like this when you're referring to a paragraph B, yet we're looking for paragraph G? So if you're not too certain, I would rather just leave the section numbers altogether, right? But from these presentations that I've sent to you, we have section numbers so you can reference them if the question requires you to reference the section numbers, right? Then I also saw something interesting from your textbook. As I was just browsing through today, before the class, I was looking at this part here. If you look at VAT, they mentioned something about, not mentioned as such. If you go to the contents page on chapter 2, contents page of chapter 2 from our textbook, have a look at how they do it. They'll say tax periods in terms of section 27. Then they'll mention vendor section 2350. So that also is, I would say it's a cheat sheet of sorts, right? Because we can actually see the section numbers that are applicable. So when looking at, say, zero rated supplies, those are contained under Section 11 of the VAT Act. So Section 11(1)(a)(i) or 1 as well deals with exported goods and services. Then paragraph A deals with direct exports. Paragraph B deals with, is it paragraph D deals with indirect exports. So you can also use these section numbers here to help you. So I don't think it's necessary that we go into the Act itself. You find that the Act tends to be a difficult place to look for answers, right? We can rely on our textbooks and just rely on the section numbers that are highlighted in our textbooks. I think that would be sufficient for our purposes, right? So you'll notice there are more section numbers there as well, so we can refer to them. Then I also just looked for legislation just so I can show you where you can find it should you need it. On the South African government website, if you search for, say, even if it's just a Google search where you say Income Tax Act, then you maybe hit PDF, you'll be able to find this Income Tax Act. So I'm getting this from www.gov.za. So my search was on the Income Tax Act, right? Then, as you can see, this does not make for easy reading, but if you need to also read from the Income Tax Act, you can also just refer to that. Then if there are other pieces of legislation that you are interested in, it could be the Companies Act, it could be the VAT Act, Estate Duty Act. You can also find them on the government website. So this is the what do you call it? The URL or the link to that. I'll share these links after the class as well, so don't worry much about them. So remember, with the Income Tax Act, we said we're using a piece of legislation that came into being in 1962, a very old document. So we also need to be a bit careful with some of the versions of the Act that we find, right? We might come across the 1962 Act, which in all likelihood looks a bit different to what we have now. So that's just something that we can also look at. Then you see that there are so many amendments that are taking place. So you can just look at maybe the most relevant or most recent amendments and make use of that. So I must say, looking at the Act will be a difficult thing to do. All right. So this is just to maybe calm the nerves a bit, should you need to refer to section numbers. All right. So I'd like to start with our homework question. All right. I'll just read the scenario, then we'll discuss it together. And maybe through that, we can all see where we got it right or where we got it wrong. Right. So this question was worth 20 marks, and the recommended time is 36 minutes. With any question, it's always a good idea to start with the required, just so we know what we're looking for. They say discuss whether or not the amounts for the rent received, as well as the amounts for the rental deposits received, constitute gross income for rent-a-flat properties for the 2021 year of assessment. In addition, state the relevant case law as part of your discussion. So if there is any court case that you can remember, then by all means, you can refer to that. Then show all relevant calculations, right? So maybe the key difference that we have now between text 3701 and say the text 2601 is that as much as we can refer to the definition of gross income, we now need to also perform a few calculations with these questions. We might get a very basic question where we don't have to calculate, but we should also just expect some bit of calculations for the questions that we're going to get. So the question says, rent a flat, built a block of flats in the Dal Park district. Construction commenced on the 15th of February 2019 and was completed on 31 January 2020. The block of flats consists of 65 two-bedroom flats. The purpose is to rent them out to tenants. and the financial year of rent a flat ends on 31 March 31 March, right? All the flats were rented out from the 1st of April 2020 at a monthly rental of 6,500 rands. Then 5 tenants have not paid their rent for March 2021 by 31 March rather, 2021. So on signing a rental agreement, tenants are required to pay a refundable deposit equal to 1 month's rent plus the rent for the first month. The deposit is refunded to the tenant when the tenant vacates the rental premises on condition that there is no damage to the property. Should there be any damages inflicted on the property when the tenant vacates, then the rental deposit is forfeited by rent a flat. There were no new incoming tenants or vacations during the course of the 2021 financial year. And they say the rental deposits paid by the tenants are kept in a separate trust account by Rent a Flat until being withdrawn to either refund the tenant or to be used to cover the repair damages. Okay. What do we make of this one? How did we conclude? I'm just interested with the conclusion for now. I'll get back to the body of the answer. But how did we conclude on this one? Anyone would like to share how they concluded? Anyone? Tandekile? You want to save me? Yeah. How did we approach it then? Maybe let's get back to the body of the question. How did we approach it?
Personally, I kind of struggled with this question because of the calculations.
Mm-hmm.
So I didn't write a conclusion. I waited until I came here
All right.
because I was very I think what threw me off was like the calculation part of it, which was why I also asked those questions in the beginning.
All right.
Yeah.
Not a problem. Let's do it together. The name of the question is, let me just say rent a flat. I think this will do. Rent a flat. Then I'll just start with this line here for an amount to be included in gross income. The following requirements must be met. Okay, then we're just looking at the requirements that we have from our gross income definition. So we have the theory or the legislation. Then we'll have the application. So let's have theory there, application. Then we can also just reference some court cases here. Then once we are done, we can have a conclusion. Right, so let's merge these two. So as far as our theory is concerned, we can say we need an amount. So let's say total amount, that's the first one. Cash or otherwise. Received by or accrued to. And in the year of assessment. And not capital in nature. All right. I'm just remembering another question you had, Karabo, was on when the question is silent about whether you're dealing with a resident or not. I'll say if they
Yes.
just work with the assumption that you're dealing with a resident. I think it's a
Okay.
safer option if they acquired
Okay.
the piece. All right.
Okay.
Just remembering it now. So total amount, cash or otherwise, received by or accrued to in the year of assessment and not capital in nature. So it seems from this question, we've got two parts that we need to deal with. There is the issue of the rent, then there is also the deposit. So our answer can address the rent on its own, then it will also address the deposit, right? So how much was received as rent for the full year of assessment? They mentioned here that the rentals will be 6,500, right? 6,500 per month. So all the flats were rented out, so it's not like we have vacant flats. So at the start of the year, on the 1st of April 2020, we have 65 tenants already, right? And these guys are paying their rentals 6,500 per month, 6,500 per month, right? So I want to split the calculation because remember they said in the last month, some of the tenants have not actually paid, right? So if we say 65, so all tenants have paid, 65 tenants have paid for 11 months and they were paying 6,500. How much will this give us? 6,500 times 11 months, 65 tenants times 11 months times 6,500 per month. How much is our total?
4,647,500 rand.
4,647,500
500.
rands. All right. So this is what we have received for the 11 months, right? Then for the last month of the year, 60 tenants have paid. This is just for 1 month. They have paid 6,500 per month. So how much was paid? 390,000, right?
Yes.
All right, perfect. Thank you. Then we have 5 other tenants, right? 5 tenants have not yet paid, right? Times 6,500 per month. How much is it? 32,500. Thank you. All right. So the total amount with regards to rentals, let's just be specific here. We're looking at rentals, right? So with rentals, just pardon me for a moment. I needed to look. All right, this is better. So we have 65 tenants have paid for 11 months, and the amount they paid is 4,647,500. Then for the last month of the year, 60 tenants have paid, which is 390. Then the 5 tenants have not yet paid, and this is 32,500. So this 32,500 is still in arrears, right? Right. So as far as amount is concerned, we want to calculate the total amount that will be gross income, right? So our total amount in question is how much? We have the 4,647,500. We have the 390. We also have 32,500, right? How much will our total be? Add 4,647 plus 5,070,000. Oh, yes. So for our total rentals, we are saying the total amount of the rentals that have been received Oh, all right. Received or accrued, because we haven't received the 32,500. The total is 5,070,000. All right. Remember, with gross income, the definition says total amount, cash or otherwise, received by or accrued to. So the company Rent a Flat is actually entitled, not entitled as such. They're going to include the 4647 as their gross income. This was received. They're also going to include the 390,000 as their gross income. This was received. Then as far as the 32,500 is concerned, they'll also have to include it as their gross income because it has accrued to them. They are unconditionally entitled to that amount. Okay. Are we happy with that?
Yes.
Yep.
Yes, we are.
Kyle, you wanted to say something?
Would they need to split the amount of that arrears, or can they have one amount on the gross income?
We could, I think, for just make it easier to understand and follow, it might be a good idea to just split them and say the 390 and the 4647,500 are the amounts that are received. Maybe let's do it here under received by or accrued to. So you could say the amounts that have been received are, we add the 4647,500 plus the 390,000, right? Then we can now say the amount that we've received is 5,037,500. Then on top of this, we can now say the rest of it is an accrual. So our accrual is that 32,500. Okay. We're still on rentals received or accrued. Okay. Are we happy with this?
Thanks much.
Thank you. So our total amount as far as the rent is concerned, I'm just focusing on rent for now. Then I'll come back to the deposit so that we can just look at this, right? How about cash or otherwise? Would you say this rent is cash or otherwise? Maybe I need to have some text here just to explain what we have done. The total amount is 5,070,000. This includes the rent received as well as still the rent that is still owing. Right? So before we can even have a question about gross income, we should have an amount first. So what is the amount? SARS will probably want to tax you on the 5,070,000, right? Which is the total of the amounts that you've received, as well as the 32,500, which is still owing. All right. Then we now say cash or otherwise. It's not, we can, for this one, we can just say the amounts are the amounts received are cash, right? When we say otherwise, this is when you receive an asset instead of the cash. So let's say one of the tenants is a painter, or an artist, yes, a painter like your Michelangelo or something, then instead of paying rent, they just give you a painting or an artwork that is worth 6,500, right? So that can also be part of gross income. Remember, the definition stays, the definition says cash or otherwise. So you either receive cash for it, or you could receive an asset for as long as that asset has an ascertainable monetary value. We're okay with that. Okay. Yes, we have a question. Asi.
My question. Oh, sorry. Good evening. I
Good.
didn't read.
It's okay. How are you?
I'm tired, but I'm okay. How are you?
I'm okay. Yeah.
My question goes for the amount that we accrued for.
Mhm.
Under the cash and otherwise, what all under? Because it can't be cash.
It can't be cash, but if I haven't received it as such, I don't know if I'm going to receive cash or otherwise, but I can maybe fall back on the contract that I have with these guys. If we don't have a contract in place that says I'll receive an asset for the rent, then I cannot assume that I'm just going to get an asset all of a sudden, right? So maybe if there's an agreement in place where we say the artist is going to give us a painting, then we can incorporate that in our solution. But since these are on a contract that says they have to pay 6,500 at the end of the month, we can just be comfortable, I think, with saying it's cash. Because with an amount that we have not yet received, it's difficult for us to say what it is that we're actually going to receive until we have received it. Then can we only say it's cash or it's otherwise? I don't know if I'm making sense there.
No, yeah, you did. I understand.
All right. Because
We assume that we're going to get it in cash. So
we're
that makes
assuming
sense.
that based on, yes, the contract that we have in place, the lease contract probably stipulates that these guys have to pay 6,500. Okay.
Okay. Thank you.
Thank you. So amounts received are cash. Then no, I like writing that. Well, let's write this. We can just mention that with right, probably not required. I'll just say I have an assumption there. The assumption is that the 32,500 will be received in the form of cash. The reason I'm making this assumption is because my lease contract, stipulates that the tenant will have to pay 6,500 rands cash. Okay. It's also good to just write down your thought process as you're doing it. Might help. Is it in the year of assessment? What do you make of these rental payments? Are they in this year of assessment? With the year of assessment, we're applying the matching principle. We want to make sure that the amounts that we're including in gross income were received or they accrued in this particular year of assessment. So our year starts or commences on the 1st of, is it April 2020, and it ends on the 31st of March 2021. And based on our calculations, we've only looked at those 2 dates, the 1st of April to the 31st of March 2021. So I think we can just mention that everything is within the 2021 year of assessment, right? So the 5,070,000 pertains to the 2021 year of assessment. I'll just remind you of the dates. The 2021 year of assessment stretches from the 1st of April 2020 to the 31st of March 2021. All right. So everything, or maybe let's have it as a statement, say everything falls between 1st of April 2020 to the 31st of March 2021. So we're not supposed to include rentals that we're going to receive, say, in the 2022 year of assessment. That will have to be accounted for in the 2022 year of assessment. All right. So here We're still dealing with rentals, so let's be specific. The rentals. Would you say the rentals are capital in nature or not? When we receive rent, is it something that's classified as a capital asset or not?
I said that it's not a capital asset because renting out flats, the company itself deals with properties, is a property developer,
Mhm.
and which means that the block of flats will be considered as trading stock.
When you rent them out, they're considered trading stock, but when you sell the block of flats itself, then it's capital in nature.
Did we sell them?
We're not.
I thought that wa- Oh,
We're not.
okay.
I'm just clarifying that when you rent it out,
Oh, okay.
when you rent
Okay.
it out, it's gross income that you get, but when you sell it, then you're selling the capital asset. Okay. Montani, Montani Pinky Tlaka, you have a question. Yes, yeah, go ahead. All right, I'll come back to you. I cannot hear anything from my side. Maybe guys, you can just confirm if you're hearing anything from Montani.
I'm not hearing anything.
All right.
I'm also not hearing nothing.
All right, thank you. If you get the chance, maybe you can try again. I think it could be the audio or something. Then you can always ask the question. I'll be more than happy to answer it. Okay. So Karabo's answer here was, how about we say this is not capital in nature, right? So you're saying it's not capital in nature. Why is it not capital in nature? We can refer to that court case. Maybe let me take this opportunity to refer to one. The FISA court case, according to this, they say we can use the fruit and tree analogy. When we sell the fruit, it's gross income. When we sell the tree, it's capital in nature, right? So it's like we're selling the fruit when we lease out the property and we collect rentals. So the rental can be likened to the fruit. But if we're to sell the flat itself, then we're going to say this is capital in nature, right? So this is not capital in nature. We can say using the fruit and tree analogy. Obviously, you can use different words depending on how you want to phrase it. Using the fruit and tree analogy, we can say that the rentals can be likened to the fruit, and the fruit will be gross income. Right? Let me see. Yes, so the tree is the capital and the fruit is the income. So the income is going to be the rentals that we receive. So that will be gross income. If we sell the tree, then it's going to be gross income. All right. Then I think another court case that comes to mind, which one comes to mind? Under received by or accrued to, we can reference the Witwatersrand Association of Racing Clubs. Then you can also reference another court case, Sheldon Hayes. I think that one would also work for us. All right. Let me push it down here. So this is another court case. Under cash or otherwise, I think we can touch on the Palatigan court case. Let's see. Received by or accrued to. Yes, I think these ones we can talk about any of those. Right. Okay. So I think based on how we've discussed this, we should be able to come to a conclusion that our income will be gross income as defined. So how much will be included? The amount to include will be the 5,070,000. So we're including 5,070,000. Of the 5,070,000, 5,037,500 has actually been received. Then the 32,500, which we have not yet received, has accrued. So then I think that will do for us. Okay. I think I saw Judith. I think I saw your name going up there. You wanted to say something, right? No, maybe it's Sushan who wants to say something. Happy? All right, we're okay for now. Thank you. So we've just dealt with the rentals. Yes, I think Montane is back for us. Yes, you can proceed. I still cannot hear anything, unfortunately. Maybe try, if you can hear me, maybe you can use the chat. I'll be able to see the message and I will answer your question. Okay. So what we've done here is, hello, yes, how are you?
I'm well, and you?
Yes, how was your day? You have a question?
Yes, I do have a question. My day was hectic because it's for the first time attending the class. I was trying to recover the previous one.
Okay.
Yeah. Okay.
Yeah.
My question is the accrual, this 32,500. It's
Yeah.
not meeting the requirement.
When you please explain, please explain. I just need to make sure I'm getting the question. Yes, the 32,500.
Yes, I get it's also meeting the requirement of gross
Yes,
margin.
yes, it meets the requirements. So we
Why
have, so it's part of the 5,070,000. If you look at the split there, the received is 5,037,500. If we add the 32,500, it will take us to that 5,070.
Oh,
So we have included,
okay.
but maybe let's be more specific. 5,037,500 received. Then we are adding the 32,500 accrued. Better, right?
Okay. Okay. Yes.
All right. Thank you.
So what happens? What happens if the tenant never pays and you already taxed on that amount?
So if the tenant never pays, right, then it becomes a bad debt. So when you write off a bad debt, you're going to be able to claim a deduction. So the deduction will have the effect of reducing your tax liability in a future period. Okay.
Okay. Okay.
Thank you for your question. It actually connects our gross income as well as our deductions. So let's say you calculate gross income on some, you include something as gross income, like you're rightly saying there. I include 32,500 because the legislation says received by or accrued to. So let's say this tenant never pays, then I should not be taxed on an amount that I never receive, right? So I can now raise a bad debt written off, right? So also, even before you even get to bad debts written off, you can start by claiming provisions for bad debts or provisions for doubtful debts. So bad debts and provisions for doubtful debts will be looked at under specific deductions. So yeah, the calculations, especially when it comes to the provision for bad debts. Okay. Yes, Pinky Clarka has the question. She says, in the year of assessment, if 35,000 is not received by 31 March, I'm thinking this is March, does it meet the requirement? So yes, it's still okay to include the 32,500 as part of our gross income because the definition says received by or accrued to. right? So with an accrual, these are amounts that you have not yet received, but you are unconditionally entitled to it. The fact that the tenant has been in your property for a whole month entitles you to that rental. So as much as they haven't paid at the year end, you're still entitled to it. It will have to be part of your gross income on the 31st of March 2021. Okay, so you can raise, right? So that 32,500, when we look at deductions, then maybe we can raise a deduction for it. We can now have, say, a provision for doubtful debts, right? Because now we are acknowledging that as much as this is gross income, chances are we might not be able to recover it from the customer. Maybe the customer has actually vacated the property, so chances of them paying after they have moved out will be lower. So we can actually, say something along those lines. But for this question, there is no need for us to touch on the deduction, though we just need to make the connection between gross income and deductions. Okay. Are we still on the same page, guys? Happy?
Happiness.
All right.
Yes.
Okay, thank you. So I just looked at rental income for now, right? How about the deposit? What do you think happens to the deposit? Because when the tenants move in, isn't they pay 1 month's deposit in advance, right? So it's like in the first month, they'll pay 6,500 times 2. The first 6,500 will be the rent for the month. Then the other 6,500 is a deposit. How do you deal with the deposit amount? Any suggestions on that one?
I didn't calculate it because I was confused with calculations, but my conclusion essentially was because it was put in a different trust
Yes.
account, and eventually when the tenant moves out, you have to either pay them back the deposits or use that deposit money to, I guess, like fix the place.
Yes.
So we're not actually receiving that deposit as our own benefit.
Yeah.
So as a result, for me, I felt like we would not include it in our gross income because essentially it's not ours. Because there's 2 ways this is going to go. It's either we pay them back or we use that money to fix the place.
Okay, so it's not ours, right? But how about when we answer that as well, we just need easy marks as well, right? Remember, for an amount to be included in gross income, we have all these requirements there. So we can start by mentioning that as far as the deposit is concerned, the amount received is 422,500. So we can also mention that this so the first part is on rentals. I should have just used this works. So there is rentals. I'm just keeping the 2 separate. Then the next one will be, should just press enter. I don't know why I'm all right, long day, I guess. All right, this will do rentals. Then let's now have the deposit. We've said the amount in question is 422,500, right? Then this was received. This is in the form of cash. Right? We don't have any mention of receiving an asset as opposed to cash. Then received by or accrued to. I think we can now reference what Dineo has said here. Then here we can say that the amount was received was not received or it's rent a flat for rent a flat's benefit. All right. for renter flats benefit. And we can also mention that the fact that these funds were put in a separate account, were put in a separate trust account, means that rent a flat does not have access to the funds. Access to the funds other than to refund the customer or to fix the damage inflicted on the property, by the tenant. Let me stick to the use of the word tenant. I've said customer here. How about we go with tenant? So something along these lines. So we're saying the deposit amount, yes, it came through to us, but it's not like we have power over that. It's in a separate account. So usually if you keep it separate, then it's a benefit to you. You're not going to be taxed on it. I want to link this to our theory as well. If you remember from last week's class, we said received by or accrued to or in favor of, right? They say the words in favor of, which are included in the definition, mean that income received by another person on behalf of the taxpayer will be included in the taxpayer's gross income. A letting agent may collect rent from the tenants in a block of flats on behalf of the owner. The owner, not the agent, will include the rental income in their gross income because it was received or accrued in their favor. But with this deposit, it's not like we've received it in our favor as well. And the fact that we've kept it in a separate trust account implies that we don't have control over it. It's separate from our checking account. Hence, yeah, hence we can say we haven't quite received it for our own benefit or to our advantage. All right. Is this clear or not quite? Clear or shaky?
It's clear, Leon. But now when I answered this name,
Mhm.
I was thinking that this deposit
Mhm.
will constitute gross income because it is money received
Mhm.
by the company for their business operation. And
Yes.
then later on, when they use the money to repair whatever that is damaged or refund it, they
Mhm.
will then include or
Mhm.
state it as a deductible expense,
So when they fix the property and when they pay,
or when they refund. Yeah.
I would not.
Isn't it that it's a liability for the company at this stage? Because
Mhm.
it must just stay in the trust account and it's a deposit.
Yes.
And then, only once it's being used for either a refund
Yeah.
or to fix the property, that's only when the business will be using it. Other than that, it's a liability at this stage. Because it's just the deposit that the company is holding. That's how I see it. Then I'm also just wanting to ask Leon, under deposits where you have point number 3, could you kindly change that to 6,500? Because that's
I
what
said
they are
65,000.
paying.
Yeah.
Please.
Sorry. It's 65 times 6,500. Thank you for pointing that out. Lusani, I like the way you're looking at it. I'm thinking yes, so usually when it comes to amounts, if I've received an amount and I put it in my bank account, then you find that by default, they're going to say you're going to be taxed on it. Then if I put it in a separate trust account, then that sort of protects me from being taxed on the amount. right? So I was a bit curious on this, and I was on SARS website. I just searched. Let me see if I can still find it. So there was some bit of guidance that I got from SARS. Let's see if this one can help us. I just downloaded the PDF, so I should be able to find it fairly easily. Well, there's lots here, probably not easy. All right, let's say sort by date. Date created. Oh God, no. Let's say, which one is this one? No, sorry, just a moment. I need to locate this document. All right, this will do. So have a look at this. Oh, sorry, I'm not sharing the page. SARS website is actually an interesting source of information, right? If there's something that you want clarity on, they actually have articles or rather interpretation notes that they have. Remember, I think from the first class we touched on what an interpretation note is, right? An interpretation note is SARS telling us how they interpret a provision of the legislation. It could be a provision from the VAT Act or a provision from the Income Tax Act, right? However, these interpretation notes are not binding on the taxpayer because this is merely SARS telling us how they interpret it. They could be wrong, which is why we can still take SARS to court, and then the courts are going to assist us with a ruling. All right. So they provided some bit of clarity on deposits. And if you go to this section, I'll share this document to you as well. There's a section on rental deposits. So they talk about it on page 8. Let's see if we can find the answer that we're looking for here. All right. So page 8 says, under property lease agreements, a lessor will usually require that the lessee pays a rental deposit, sometimes also referred to as a security deposit on entering into a lease agreement. So there's actually, they say the Rental Housing Act of 1990 applies to the leasing of a dwelling, which includes a house, hostel, I'm saying hostel like I'm saying hotel, hostel, room, hut, shack, flat, apartment, room, outbuilding, right? I just need to see how they deal with it. Right. So Section 5(3) of the Rental Housing Act deems a lease to include certain terms and amongst others the following, right? I just want the ruling, that's what I want. All right, maybe this will be what we're looking for. They say a rental deposit is distinguishable from an upfront rental payment and a lease premium. So the facts and circumstances of each case should be considered to determine whether the amount received constitutes a rental deposit or an upfront rental or a lease premium. So the income tax treatment of the rental deposit is considered above. So where have they considered it? Deposit, all right. There must be a scenario here. I'm just looking at the result. They say the deposit received does not form part of the lessor's gross income in the year of assessment. Monthly rental is gross income, right? So I'm taking this to mean that when there's a deposit, it usually does not form part of the lessor's gross income. A property owner entered into a lease agreement and received a deposit of 10,000 upon the commencement of the lease. Under the lease agreement, the deposit is refundable upon expiry of the lease. However, to the extent that the lessee has outstanding obligations owing to the lessor under the agreement, these may be set off against the deposit and the net amount returned to the lessee, right? They say the lessee had outstanding obligations as set out, then the outstanding rent was 4,000. Then damages 7,000, so they were set off against the 10,000. So 4 and 3, 7. 10 minus 7 gives us 3. So only the 3,000 was returned to the tenant, right? So here they're saying in the 2019 year of assessment, the 10,000 does not form part of the lessor's gross income. So when you receive it, it's not yours really, right? It only becomes yours when certain conditions have been met. If a lessee fails to pay rentals, in which case you now have to withhold a portion, or maybe there are damages inflicted on the property, in which case you now have to also withhold a portion. So unless those things happen, the 10,000 rand deposit is not ours. So I would say the similar principle applies to the 60, how much was it? Similar principle applies to
422,500 deposit.
yes, the same principle applies to the 422,500. Thank you. Are we happy with how they have explained it from that document as well?
Yes.
And may you please share the document with us on the group if you don't mind?
I don't mind. I'll share it. I saw something interesting from reading this document as well. So there was a part here where they're talking about bank accounts and separate bank accounts like the trust accounts that we're talking about, and how there sometimes you might put an amount of money in a separate bank account and it does not protect you. You're still going to be taxed on it. So this was in the context of returnable containers, so more like a deposit. Still remember how, for example, when you buy Fanta or Coca-Cola in a glass bottle, which you could return to the shops and they would give you a deposit, right? Still remember that? I've seen a bottle recently and I was like, I haven't used this in a long time. So yes, if you still remember that example, that would be perfect. So one of the issues around those deposits now is what happens when Pick n Pay collects money from you, and that includes the value of the bottle that you have to return, right? I think this example is a bit off in our context now because I don't think many of us have bought using that. Do we remember that? Have we used it before? Where you buy Coke in a glass bottle?
Yes,
We still
yes.
do it when we are at
We
home.
still
We
do
are that
that.
old.
Still doing it, hey? Yes.
Yeah, it's still
Yeah.
happening.
I thought it's not happening anymore because you're so quiet. I'm like, maybe I'm the old one out.
No, I feel like if you live in the hood, then you still
Yeah,
definitely
you
do
still
that.
It's
true.
still there,
Or in
right?
the rural areas.
They still
Yes, 100%.
because growing up, I remember that was the only way that we used to have Coke. Then later on, you start seeing those plastic containers and cans. But for me and in my context, that's what I was used to. So here they say the use of separate bank accounts for deposits does not in itself override the true nature of the transaction and intention of the taxpayer. Thus, even if the taxpayer keeps the deposits in a separate bank account, but there is no intention of refunding them, they must be included in gross income in the year of assessment in which they are received. So I guess the key word there is no intention of refunding them. For the example that we're using now, there is definitely an intention to refund. If everything is in order, then you should return the deposit that the customer has paid. So they refer to this court case, and it's also included in our summary of court cases. They say these court cases support the view that an amount which has been received by a taxpayer for the taxpayer's own benefit and which may be used by the taxpayer in the business must be included in the gross income, notwithstanding that the taxpayer may have undertaken a contingent obligation to repay all or a portion of the receipt under the specified circumstances, which may or may not happen, assuming receipt precedes accrual. All right. So I guess key words there would be if you have received it to your own benefit. the fact that it's in a trust account implies it's not quite to our benefit because we cannot use it except for what it is intended for. Okay, so I'll share this document, then you can just browse through. They touch on a number of issues, and you might not get exactly the same questions when you get tested, but I guess this will just sort of allow you to see how SARS operates, how they look at things, and usually what stance they tend to take when it comes to transactions. Right, so I'll share this, then you can also use it as well. So here we can say rentals have been received, but they're not to our benefit, so I cannot just consider it here. For the sake of completion, I'll just mention that the deposit was received in the year of assessment, just to score some easy marks here. The deposit of 422,500 was received in the 2021 year of assessment. Remember, the 2021 year of assessment stretches from the 1st of April 2020 to the 31st of March 2021. Okay. Then not capital in nature. I think this is not capital as well. It's not like we're selling a capital asset. These are not proceeds from the sale of a capital asset. So the deposit is not capital in nature. So our conclusion there would be to say the rental income is going to be part of gross income, but the deposit is not part of gross income. This should not be included in gross income. And the reason that we are relying on there is that, I'll just copy this part and say, deposit not included in gross income. These funds were put in a separate trust account, and that means that Rent-A-Flat does not have access to them, other than to refund the tenant or to fix damage on the property. So it is not received for the benefit. Is it for or to the benefit? Not too sure. It's not an English exam. Not received for or to the benefit of Rent-A-Flat. Okay, so there is our conclusion right there.
Leon, can I ask, ne? Maybe this is me just being unnecessary, but how do they ensure that this money, okay, obviously they're refundable, the what do we call them? The tenant is going to receive the money, but how do they ensure that the money that is said to be used for the fixing of damaged properties is actually used for that? Because they might state that they are going to use the money for the fixing of damaged property by the tenant, but then not use the money for that. So SARS is getting robbed.
We're protecting SARS now.
No, we're not, but I'm just...
How trust accounts work. All right. Let me see. Maybe Unati wants to help me out there. Unati, you have a question?
Okay, good evening. No, not really a question. I just want to quickly maybe give an insight based on a personal experience to a question. I didn't get her name. So basically,
Yes.
what happens is that these agents, when they fix anything, they have to produce receipts, invoices and things, right? So I think that way they can always reference back to say, this is what we used for the money, and these are the invoices, this is the money that was paid. And also just to say, also, this is also based on the little bit that I know, Nje, not
Yes.
conclusive. It is what it is.
Yeah.
Trust money or money like deposits and any other money
Mhm.
that either the agents or the lawyers keep on behalf of clients are not their gross income, because it's not their money up until, as you said, up until they have to pay, or let's say, for example, lawyers as well. Lawyers keep money
Mhm.
for clients,
Yeah.
but that is not their money, right? Up until they render certain services to the client,
Yeah.
then they can take from that money. So applies with agents,
Mhm.
right? Whatever money that they have to take, let's say I have a tenant here and the tenant moves out,
Yeah.
then the agent is the one keeping that money for
Yeah.
the client on the trust account, sort
Yeah.
of like kind of an investment account that they open, because they also incur interest for that money. So whatever damages I give to them to say this what needs to be fixed,
Mhm.
they need to get an invoice or some proof to say that this was paid, and so just to answer that, but that's just based on the little bit that I've experienced. It's not conclusive, but yeah.
It actually explains where you actually explain it well. Hey, Lusani, are you happy with that?
Yeah, she explained very well. Thank you, Nati.
All right.
Okay, thank you.
Thank you. All right. So I guess supporting documents there would be the thing that we're looking for. Just got curious as Unati was answering that. I Googled something. I just said, how do trust bank accounts work? In the age of information, we might as well put it to good use. Here it says, a trust account works like any bank account does. Funds can be deposited into it and payments made from it. However, unlike most bank accounts, it is not held or owned by an individual or a business. Instead, a trust account is set up in the name of the trust itself, such as the Jane Doe Trust. So I guess before you can use it, right? I'm thinking now in the context of a trust as a legal entity. Then we can say there's a trustee who ensures that the money is used only for its intended purpose. So maybe just to supplement to what Unatia said, not that we needed to add anything anyways. Okay. Happy with this question, guys? Does it maybe shed light on gross income for us?
Yes.
Yeah, it definitely does, because I feel like it touches on so many different like components. Because I think from last week I was just under the assumption that when you do one question, you think that that is just the general consensus or theme of how questions like be asked. So I feel like it definitely like challenged us in a good way.
All right. Thank you for that comment there. And I guess for our questions, we have to also realize that there are easy marks on a question, all right? So as much as what we are answering might not be so straightforward, I think these are marks that we definitely need to make sure we get. Just stating the obvious, right? Then some of these calculations, maybe you find they're easier calculations to make. But with the application, always remember, you're tying back the theory to the scenario that we have. If the theory says you need an amount, you're now going back to the scenario and you're looking for an amount, right? If there is no amount, then there is no gross income. All right. Let's see. I think that's it. All right. So we can, yeah. I think with application, we're linking the theory to the scenario that we have. Then that would be all. So I need to touch on something else here. Let me just clear these. Then let's go to this. I'll share this answer that I have. But always remember, when you're writing it, you're also using your own words. So your attempt might be slightly different to what we have there. But as long as we touch on the main principles, I guess everything should be okay. All right. Then going back to this, maybe let me go to exemptions, right? So for those who are doing text 3701, for some reason, exemptions are not a big topic for text 3701, but for text 3761, they've actually devoted a whole learning unit to look at exemptions. I think in 3701, they have combined these exemptions together with gross income under one learning unit, if I'm still remembering things correctly, right? So with exemptions, they say we have certain income items that in terms of section 1, right, they will be part of our gross income. They meet the requirements for it to be gross income. Maybe if it doesn't meet the requirements, it's a special inclusion, right? So those items will have to be part of gross income, right? But for some reason, there are some other income items that that the National Treasury, right, does not want to tax us on, right? So as far as exemptions are concerned, we can split them into two and say we've got two types of exemptions. Those exemptions owing to the status of the taxpayer and exemptions owing to the nature of income, right? The ones that we're going to maybe encounter more are those owing to the nature of income, right? So under status of the taxpayer, they say nature of income plays no role. So you just look at the status of the taxpayer. Some persons do not pay any tax. For example, the government, right? If the government were to pay tax, who are they paying tax to, right? They're paying tax to themselves, right? Which really doesn't make much sense, right? So governments, local government, state government, provincial government, those arms of government do not pay any tax, right? So if you encounter the government, you come across a question that has to do with the government, then you can safely say that there is no tax that will have to be paid by the government because the government is a tax-exempt entity, right? Political parties do not pay tax. They're also exempt. Public benefit organizations are also exempt, right? Pension fund, retirement annuity fund, provident funds, those will also be exempt. The official of another government who is not a South African resident, they will not be paying tax, so they're exempt from tax. So think of the American ambassador, right, at the embassy there in Pretoria, right? They are an official of another government. They don't pay tax in South Africa. The same would apply to a South African ambassador in the United States, right? Chances are those guys are also not going to pay tax when they're in a foreign state, right? The owner or charter of any ship or aircraft who is not a resident of South Africa, then the pension that is payable to the state president, the vice president, or his widow, right? So Gracia Machel would probably not pay tax on the pension that she receives on behalf of her late husband. Okay, so these taxpayers that we have here are not going to pay any tax owing to their status, right? Then there are some exemptions. I think for now, we just need to have an awareness of part 2 here, but we're going to look at them later on when we focus on non-residents as a learning unit, as a separate learning unit. There are certain exemptions that apply to non-residents, right? So when non-residents receive South African interest, dividends, royalties, even foreign entertainers, as well as the employment of non-residents, they say that the income that they receive is exempt, but that doesn't mean that they don't pay tax. So if I give the example of a foreign entertainer, right? Let's say Beyonce, or why does it have to be? All right, let's stick with Beyonce, right? I'm not even a fan, but here I am using her as an example. All right, thinking of songs now. All right, back to Beyonce.
Oh, that's single ladies.
Yes, these single ladies. Beyonce comes to South Africa. She performs single ladies at the at the women's conference. So she's a non-resident. She's not from South Africa, right? So SARS is not going to wait for Beyonce to file a tax return and pay tax to SARS, right? And chances are, if Beyonce goes, if she leaves South Africa, there is no way of collecting outstanding taxes from her. So let's say the event organizers, right, that brought her into South Africa have paid Beyonce an appearance fee of 10 million rands, right? So before they even give Beyonce the 10 million rands, they have to withhold, I think it's 20%, right? They have to withhold 20% of the 10 million rand and pay it over to SARS. If not 20, it must be 15. I could be mixing things up there, right? So they withhold that, then they pay it over to SARS. So when Beyonce receives the net amount, she doesn't owe SARS anymore, right? So that's why when we look at it, we might say that Beyonce, as a non-resident, as a foreign entertainer, is not paying tax, right? She is not paying tax on her own behalf, but before she even received the full amount, right, tax was subtracted from the income that she earned whilst she was in South Africa, right? So these exemptions will be dealt with a bit later on, but for now, we just need to have an awareness of them, right? Then the other exemptions are owing to the nature of income, right? So certain income items are going to be exempt, right? So we have partial exemptions and we also have full exemptions. So there are those items which are just going to be exempt in full. An example of that is a local dividend. So if you receive a dividend from a South African company, then that full dividend will be exempt from tax. All right. If you receive local interest is not fully exempt, it's only partially exempt. So a portion of that interest will be exempt, then a portion of it will be taxable, right? So what is the difference between then an exemption and a deduction? You say an exemption is only if a taxpayer has earned a certain class of income, right? As an example, let's say you earn local dividends, right? If you earn local dividends, you qualify for the local dividend exemption, right? It's not like you can just get an exemption without earning the dividend first, right? So for an exemption, it's firstly going to be gross income, then we take a portion of it out. By contrast, a deduction is irrespective of whether the taxpayer has earned a certain class of income or not. He may get a deduction. And remember, deductions are for expenses that you have incurred in the production of income. So let's say you need to rent an office space. So the rentals that you pay will be an allowable deduction, right? It's a necessary expense in the production of income. So SARS will give you a deduction because they know they're going to tax you on the income. So they'll be like, yes, it's okay for you to rent this office space. We're going to allow you to deduct the expenses that you have incurred in renting this office space. But when you now get income as a result of that, we are going to tax you on that income. So for you to claim a deduction, it seems there has to be that link or connection between the expense and the income. So the expense must have been incurred with the intention of producing income. So if that intention is not there, then chances are that deduction will be disallowed, right? But that's for the next learning unit, right? So the exemptions that we have are for war pensions and awards for diseases, disability pensions, and workmen's compensation, right? So let's say you fought in the war, right? And yeah, you fought and you got a pension as a result of that, right? Or you're disabled as a result of injuries that you incurred at work or that you suffered at work, sorry, then the war pension or the disability pension will be exempt. So it forms part of your gross income because gross income says total amount received will have to be gross income. But the exemptions are now saying, but we should not be taxing you on the money that you get as a result of the injuries that you suffered at work, right? Then for war pensions, right, we have to to be fair to our veterans, right? They fight to protect our sovereignty. They fight to protect our freedoms and all that. So, right, the pensions that they get as a result of that should also be exempt. So it's just a thank you to the veterans. All right. Then we have foreign pensions. If you earn a foreign pension, they say the foreign portion of a pension that relates to both South African employment and foreign employment will be exempt from tax, right? So let's say you are a South African resident for tax purposes, and for 5 years you are working in the United Kingdom, and when you retire, you now get a pension, right? From the United Kingdom as well as from South Africa. So they're now saying the portion that you get from your time that you were away from South Africa is exempt. So SARS is like, we're not going to tax you on the portion that we're not going to tax you for the pension that you receive as a result of employment outside the Republic of South Africa, right? So when you come across a foreign pension, it's going to be gross income for the individual. Then you're also going to take it out. So you're going to exempt that amount in full, right? UIF, if you receive any UIF, it's going to be exempt. Also doesn't make sense that they should tax you on UIF. So you receive it, it's gross income. Then you also have to take it out. So it will be an exemption, all right? We have uniform allowances. So if you receive a uniform allowance, it's generally exempt, but for it to be exempt, there are conditions, right? I think these are areas where we can also expect theoretical questions, right? Just small questions. They tend to like these kinds of questions. So let's say you receive a uniform allowance of 20,000 rands, right? The general rule is that that uniform allowance will be exempt, but it's only exempt if these three conditions are met, right? The employee should wear the uniform as a condition of his employment. The uniform should be worn whilst you're on duty, and the uniform should be clearly distinguishable from ordinary clothing, right? So if your uniform is going to be a pair of jeans and a white t-shirt, then unfortunately you're not going to claim an exemption for it because it's not clearly distinguishable from ordinary clothing, right? So let's say you have to wear a navy suit for work and there's no branding, there's no logo on your suit, right? Unfortunately, you cannot claim the uniform allowance for that as an exemption because clearly it's not distinguishable from ordinary clothing, right? For it to be distinguishable, I think anyone should just see you and conclude that you work at such and such a place. An example of that would be the uniform that is worn by medical professionals, right? The nurse, the doctors, or something that is worn by a pilot. We can also give the example of a fireman, a firefighter. We could also have police officers, military personnel. You see that person wearing their uniform and you can tell that this person works for the South African Correctional Services, right? Department of Correctional Services. You can see that this is someone from the police force. This is someone from the hospital, right? So if your uniform is not distinguishable, then unfortunately you cannot claim an exemption, right? Then relocation benefits are also exempt. So let's say you have to move from Durban to Bloemfontein and your employer pays for the relocation, right? So the cost that the employer incurs is going to be exempt. So when you receive the relocation benefits, they're going to be part of your gross income, but you're not going to be taxed on them because now you're exempting. So the effect is you add, then you subtract, right? But we also have some conditions, if I can say. So relocation benefits which are exempt are those that you incur for transporting the employee, his household, and their possessions. the costs incurred by the employee in respect of the sale of their previous residence and settling in at a new place of residence, and this has to be approved by the commissioner. And in respect of the hiring of accommodation in a hotel or elsewhere, right, for employee and his family for a period ending 183 days after the transfer. So it's limited to the first 183 days, and 183 days is the same as 6 months, right? So your employer can pay for your rent for the next 6 months after relocating, and the benefit, the rentals that are paid for the first 6 months are going to be exempt. Then anything paid after the 6 months will have to be taxable, right? Alimony or maintenance money, this is also exempt. Then local interest, this depends on the age of the taxpayer. If you're younger than 65, then the first 23,800 will be exempt. If you're 65 or older, then the first 34,500 will be exempt, right? We also have amounts received from tax-free investments. They are also going to be exempt. You don't need to pay tax on them. They are tax-free anyways, right? If you receive a dividend from a local company, then it's also going to be exempt. So the full amount is gross income, then the full amount will also be exempt. So you're not going to be taxed on a dividend that you receive from a South African source, from a South African resident company. Okay. Yes, we have a question.
May you please explain the local interest exemption? I'm not understanding correctly. Does it mean that if I've got or I'm earning local interest, the deduction, no, wait, the exemption will be reduced by 23,800?
All right, let me just make use of an example to illustrate that point. Thank you for your question, Atsi. Just let me know if I manage to answer your question. I'm just moving to a different page now. So let's say you received local interest. How much are we receiving? Let's say 50,000 rands. So remember, we're calculating our tax liability. So I will have the interest received. It should be interest. I'll have the 50,000. So this is going to be gross income, right? Then I'll then say exemption. What is the age of the taxpayer? Our taxpayer, let's say, is 45 years old. So if you're 45 years old, you're younger than 65, so your exemption is limited to 23,800. So you've included the 50,000 as your gross income, then you're now taking out the 23,800 as your exemption. So the effect of this is that it will reduce your tax liability. Okay.
Okay, no, I understand.
Okay.
I understand now.
How about if you're
Thank you.
Thank you.
Sorry?
How about if you're 75? What happens? Your exemption changes. Now,
34,500.
yes, it's now 34,500. So the exemption is dependent on your age. Those who are younger than 65, they get 23,800, and those older than 65 will get 34,500. Okay.
But now my question
What if
follows.
What is, sorry, I didn't get that part.
Okay, what if your interest received was 20,000?
What if it was 20,000? So you received 20,000, then your exemption is going to be 20,000. Your full exemption is 34,500, but this is the limit.
Okay.
So I cannot exempt what I did not receive. So I'm now restricted to the amount that I received. I only received 20,000. So my exemption is now limited to the 20,000. So the moment I then get more than, say, the 34,000, that's when the 34,500 kicks in.
Okay.
Okay.
Thank you.
Thank you for your question. I think it's very easy to make the mistake of doing it like this. But this would be wrong because you're now exempting more than what you actually received. So we have to limit it to the 20,000. All right. Kyle, you have a question?
So, just two questions. So,
Mhm.
when we were busy with the top section of dividends and interest, you said dividend is full and interest is portion. Are you referring to this?
Yes, yes, that's correct. So our interest is, yes, it's partial. So it's not always the full amount of the interest that you received that is going to be exempt. But if this was a local dividend, then it's a full exemption. So let's say you receive 100,000, then the full 100,000 will be exempt. So dividends are a full exemption, then interest is a partial exemption. That's a correct observation.
Thanks. And then my second question is, are you entitled to receive this exemption every year if you receive interest every year, local interest?
Yes, yes. So that's it's limited to this 34,500 every single year. So you cannot just claim more than 34,500 for this year of assessment. So every year we reset the counter. You are entitled to the 34,500 if you're older than 65 and 23,800 if you're younger than 65.
Thanks.
All right, thank you. Are we still on the same page, guys?
Yes.
Okay, thank you, Nati. Still on the same page. Perfect. All right, let's go back and touch on some of these exemptions. So with dividends, if you're doing a question and they just say dividends, right, they are usually referring to a local dividend. So if they say dividend, they're referring to a local dividend. If they say foreign dividends, only then can we say they are referring to a foreign dividend, right? So with our foreign dividends, we have a foreign dividend exemption of 25/45. All right. So what it means is, let's say you receive a dividend, right? Let me just use the example. It's probably easier if I illustrate like this. And this provision applies to individuals, right? So I think I will have to update the notes and make sure that we remember that. So let's say an individual receives a foreign dividend of 60,000. It's going to be gross income. Then the exemption for foreign dividends is going to be 25/45 of the 60,000, right? If we take 25 divided by 45 times 60,000, that gives us 33,333. So this will be our exemption, right? So this provision applies to individuals, right? This is too much. This provision applies to individuals. Then this provision here also applies to individuals. This interest exemption, right? Let me just say this applies to individuals as well. Okay. So if we go back, we have foreign dividends, say foreign and headquarter company dividends. These ones we need to touch on them. They say you need to learn that these foreign dividends are fully exempt from tax. So if you receive foreign and headquarter company dividends, These are exempt, so I feel this is not as clear. I'll need to add stuff to this one so that it's a bit more straightforward, right? So I think I'll add more to this and resend this document. We also have what they call real estate investment trust. Any amounts distributed by a real estate investment trust are fully taxable in the recipient's hands. Then where such a distribution is in the form of dividend, then the dividend is not exempt in the recipient's hands, right? This exclusion from the dividend exemption also applies regarding dividends distributed by a subsidiary of an REIT, so-called controlled company, right? So if you just come across this, just remember the exemption there. So the dividend exemption will, however, apply where the company distributes a dividend to a non-resident, or they distribute an amount to a holder of a share as consideration for the acquisition of shares in that company, right? And you'll also notice that section numbers are included, right? For those who still want to use them. For every exemption that I'm talking about, there is a section number. For example, under uniform allowance, it's section 10(1) NA, right? So if you need it, the section numbers are there. We have purchased annuities. I think let me touch on this one. They say the general rule is that amounts that are received as an annuity are included in a person's gross income, right? If you go back to special inclusions, we need to make that connection as well. Under special inclusions, we have annuities, right? Special inclusions, annuities. So any amount that you receive as an annuity is going to be part of gross income because it's a special inclusion, right? But now we have a purchased annuity, right? So you might approach, say, a company like Old Mutual, then you pay them an upfront 300,000 rands, then they will agree to pay you, say, 3,000 rands per month for the rest of your life, right? That's a purchased annuity, right? So when you have an arrangement like that, it has that the amount that you receive will have two portions or two components. There's a portion that you're going to say it's a capital portion, which is not going to be part of gross income. Then there's a taxable portion, which is going to be part of your gross income, right? So the capital portion will be the exemption. Then the taxable portion is what you include in your gross income, all right? So they say, however, the capital portion of certain annuities are in some cases exempt from normal tax. The capital element of an annuity amount is calculated by means of the following formula. So the formula is Y is equal to A over B times C, right? I need to make use of this example from test 1 from 2022, right? If you look at, let me just come back to this part, to the exemptions. They say Y is equal to A over B times C. So we're calculating Y, which is the capital portion. So Y is the capital amount, the exempt amount to be calculated. Then A is the amount of total cash consideration paid by the purchaser of the annuity. Then B represents the total expected return of all the annuities provided for in the annuity contract. Then C is the annuity amount received for this year of assessment, right? So let's use this question as an example, right? It's just a short one. It's worth, what, 5 marks? They say our taxpayer, remember we did part A when we looked at VAT. The part B of the question says we have Shirley, who receives the following amounts during the 2022 year of assessment. So on the 1st of July 2021, she purchased an annuity for 350,000 rands to secure her retirement income. In terms of the purchased annuity contract, Shirley was to receive an amount of 2,500 per month for 15 years with effect from 1 August 2021. Right? And here they say, discuss with supporting calculations which amounts will be included in or excluded from Shirley Masete's gross income for the current year of assessment. Provide brief reasons for your answer. Right? So we can say for this one, how much did Shirley receive? Right? Shirley is going to receive 2,500 per month, and this is going to be for a total of 15 years, right? And this will kick in from the 1st of August 2021, right? So remember the year of assessment of an individual, it stretches from, let's say, year of assessment of an individual. Year of assessment of an individual, it stretches from the 1st of March to the 28th of Feb. So for an individual, it's always going to be the same. For a company, the year of assessment will depend on the financial year, all right? So Shirley purchased this annuity on the 1st of July 2021, and we're looking at the 2022 year of assessment, which ends on 28 Feb 2022. So she'll start receiving 2,500 from the 1st of August 2021. So the amounts that she'll receive will be for August, September, October, November, December, January, and February. So she'll receive a total of 7 payments. Right? So it's 2,500 per month. So this is a purchased annuity. So the full amount is not going to be gross income, right? A portion of that amount will be gross income. Then a portion of that amount will be capital in nature, and it will not be part of our gross income. So the formula that we use is Y is equal to A plus B, A over B times C, where Y is the capital amount, then A is amount paid to purchase the annuity, then B are the total receipts, then C is how much was received. Let me say total receipts for the year of assessment. Okay, so we can now have Y, which is the amount that we're calculating, is equal to A, how much we purchased the annuity for. They say Shirley purchased it for 350, so we can have 350,000 divided by B, which are the total receipts. So how much is Shirley going to receive in total from this contract, right? She'll receive 2,500 per month. There are 12 months in a year, and this is for a total of 15 years, right? Then how much did she receive for the current year of assessment? She received 2,500 7 times from August right through to February, right? So it's A, 350. This is how much she purchased the annuity for. Then B is how much will Shirley receive in total from this contract. We're not just looking at this year of assessment. So she'll receive 2,500 per year, per month. So in a year, she'll receive 2,500 times 12, right? In 15 years, he'll receive 2,500 times 12 times 15. Right? So this will give us 350 over, if I take
450.
450.
Yes.
Thank you, 450,000. And this will give us
17,500.
75, right? 17.5. Then how much is our Y?
It's 1,361.
611.
1,3. Yeah.
All right. So 13611 is our Y. Y is the capital portion, right? So Shirley has received 17,500. Then of the 17,500, the 13,600 is the capital portion. The capital is exempt. So what is taxable is going to be the difference between these two amounts. So 17,500 less 13,611. And that gives us 3,889. Are we happy with that?
Yes.
Okay. So I want to give you other examples that you can try. One example is not going to give us all.
Can I ask a question? Hi,
Hi, how are you, Kumo?
good on yourself.
I'm all
I'm the part where you get the 17,500. Can you please?
explain that part. Okay. So the 17,500 is C, right? So this is the C part. So these are the total receipts. These are the total receipts for the current
Okay.
year of assessment, right? So
Mhm.
the year of assessment of an individual will start on the 1st of March and end on the 28th of Feb. So if we're in the 2022 year of assessment, it implies the year ends on 28 Feb 2022, right? So it would have started on the 1st of March 2021. So
Yeah.
from the information that we get, they say that
Mm.
Shirley will start receiving the annuity from the 1st of August 2021. So that's when the contract sort of kicks in. So how many months? So it's a monthly amount.
Oh.
So in August, you'll receive one payment. September, another one. August, September, October, November, December, January, and Feb. So that gives us a total of the 7 payments. And each payment is 2,500. So that's how we got to 2,500 times 7.
Oh, okay. No, I get it.
All right.
Thank you.
Thank you for your question. All right. So remember what we're calculating here is the capital portion. So the capital portion is the exempt portion, right? So I've received a total of 17,500. I will exempt the capital portion. Then the taxable amount is the 3,889. Okay. So if you could remember this, in 2022, that was worth 5 marks. Okay. All right. Let's come back to this part. So from your textbook, I just want to find an example that you can make use of. This is purchased annuities. I've moved too much. All right. Gross income. I want to look at purchased annuities.
Excuse me, Leon.
Yes, how are you?
I'm all right, thank you. How are you doing?
I'm well, thank you. Yes, Patricia, you have a question?
Yes, I do. I
Mhm.
was actually going through a tutorial for 2021,
Mhm.
and I did, I think there are how many questions? There are 3 I did this afternoon.
Yes.
But then can I just go through the question so that I couldn't understand because in the calculation of the amount, they used, okay, let me read the question, then maybe you'll be able to assist me.
Okay.
So the question goes, on 1st May 2020, Jacob withdrew 250,000 from his savings account in order to purchase an annuity. He was 60 years old, and in terms of the purchase annuity contract, Jacob was to receive an annuity of 2,000 per month for life with effect from 1 June 2020.
Yes.
And then required, it says, calculate the taxable portion of the total annuities that
Yes.
Jacob received during the 2021 year of assessment. So there's a solution that they did. And what I didn't understand was, because the other questions, it actually says that
15 years or 10 years, right?
yes, but this one is quiet. And then when I looked at the solutions, there was an amount, they put like, when they were calculating, they were saying 14.61 years. So I was wondering why, because another one talks about, I think, for life.
Yes. So
yes. So how does one know if they haven't if they haven't put the years, because the other questions are saying for the next 10 or 15 years, and then the other one says for life.
Yes.
So I got confused. Where did they get? Oh, okay.
Sorry, you see it now. So when you receive something for life, right?
Yes.
It's going to be tied to your life expectancy. So we look at, you said it was Jacob, right?
Yes.
Jacob is 60 years old.
Yes.
So Jacob is going to receive this annuity for life. And according to the life expectancy tables, Jacob will receive this for 14.61 years. So where we would say 15 years, now we are taking 14.61 times the amount of money that he's receiving per year. Then we'll get to our answer. So this 14.61 then replaces that 15 years that we used, say, for this example that we did together. All right.
Okay. Thank you so much.
You're welcome. And just as a note as well, when you look at the life expectancy, just make sure you're using the correct column.
Yes.
The ladies have an advantage here. You live longer than us. I don't like that at all. So for Jacob has a life expectancy of only 14.6. Yet, if Jacob was a female, she'll have a life expectancy of 18.78. So just make sure you're using the correct column there, as it was.
Okay, thank you. Thank you so much.
Thank you. So life expectancy tables will have to be provided to you in an exam. No need to memorize them. We just need to know how to use them. Okay. All right. So I think, Patricia, there, it's like you were reading my mind. I wanted to find a question for you that you could try where they say the contract is for life as opposed to saying it's for a 15-year period. So have a look at this question here from the textbook, right? Example 6.7. So for this one, they said Chris is 56. He will receive an annuity from the insurer. He paid 250,000 for the annuity, and he will receive 2,000 per month for the rest of his life. His life expectancy, according to the table, is 17.18. So if they provide you with the life expectancy, you just use it. If it's not provided, then you go to those life expectancy table and you're looking for a male who is 56 years old, then you should be able to get this 17.18. So how does this affect the calculation? Y is equal to A over B times C. A is the amount that he purchased the annuity for. Then B are the total receipts. It's how much? 2,000 per month. So 2,000 times 12 times the life expectancy, 17.81, which gives us 412,320. Then the total receipts for the year, you'll start receiving this in September. Remember, the year of assessment always ends in Feb. So it's September, October, November, December, January, February. That's 6 months. 6 months times 2,000 per month. That's how they got to this. How much? How much? Which year of assessment are we looking at here? On 1 August 2022, Chris purchased an annuity, right? Then they started receiving a monthly annuity of 2,000 from 1 September 2022. And how much, you see the trick that we fell for here is how much, calculate the total taxable amount of the annuity received for the current year of assessment. We're no longer in the 2022 year. So in 2022, they would have received from September to February, but for 2024, we are receiving for a full year. So that's why they are having 24,000, 2,000 times 12, not 2,000 times 6. Let me explain this part with the help of my pictures here. Let's see. So in the 2022 year of assessment, it will be from 1 September 2021 to 28 Feb 2022. So in this year of assessment, your C will be 2,000 times 6 months, because this period here is only 6 months. So 2,000 times 6 will give us 12,000 for our C. But if we're now in the 2023 year of assessment, on 28 Feb 2023, this is now 12 months. So our C is now 2,000 times 12, which gives us 24,000. Then in the 2024 year of assessment, on 28 Feb 2024, this is also a period of 12 months. And our C is going to be 2,000 times 12, which is 24,000. So it depends on the year of assessment that you're looking at. In 2022, this is the 2022 year of assessment. This is the 2023. This is the 2024. So in 2022, you only received 12,000. In 2023, 24,000. 2024, 24,000. So that affects how much we have as our C. Because remember, C is the total received or receipts for the year of assessment. Okay. Are we happy with that? Are we happy with that part?
Yes, we're happy.
All right. Thank you. So let me take you back to this one. So just have a look at these questions. There's question 6 point. Oh, it's the only one, so there's not much to do afterwards. So you can just have a look at this one, the example 6.7 again, if you want to try it again. But I don't think there'll be much to it anyways. Okay. So coming back to our exemptions, we have bursaries. So bursaries, if the employer provides a bursary for, or rather to an employee, they say where a scholarship or bursary is granted by an employer to an employee, it will only be exempt where the employee agrees to reimburse the employer if they fail to complete their studies for reasons other than health, death, or injury. So if you receive a bursary from your employer, it's going to be exempt only when there's a stipulation within the contract that says that you're going to pay back if you don't finish your studies for reasons other than death, ill health, or injury. Then if it's a bursary that is provided to relatives of employees, then we have exemptions dependent on whether the relative has a disability, as well as depending on the NQF level. So let's say the relative has does not have a disability, then the exemption will be an amount of 20,000 per year in respect of grade R to grade 12, or we can say a qualification of NQF level 1 to 4, right? Then it's 60,000 for NQF level 5 right up to NQF level 10, right? Then if the person, the relative, has a disability, you notice that these amounts are increased from 20,000 to 30,000, then from 60,000 to 90,000. Okay, so those are our exemptions. I'll just go through the chapter again. I need to make sure that I haven't left out any exemptions. Then I'll just update this and send the updates to you. So what you can do for me as homework is just to look at the question that we get from the guide, not from the guide, from the textbook. Have a look at this one. This is not a very big topic, so it will be just small. They say calculate Mr. Nkele, Mr. Nkele's income for the current year of assessment. Just have a look at this example 6.8 on page 261, right? So in next week's class, I'll start by looking at these exemptions. I'll probably add a few rules for the exemptions as well. Then once we are done with that, I want to move to deductions, right? So I'll also share a summary of deductions with you so you can go through it beforehand. I'll also share a question that you can attempt. Then through going through this, I think everything will make sense, right? So with our deductions, we have a general deduction formula. So if you're still paying attention to section numbers, it's section 11A and section 23. So section 11A, sometimes they say this is the positive side of the test. Section 11A tells us what can be deducted. And section 23, on the other hand, tells us what cannot be deducted, which are the prohibited deductions. So together, section 11A and section 23 make up the general deduction formula. Okay, so it's not a general deduction formula if you're just looking at section 11A and not section 23 as well. So we usually look at both of them together. Then, yeah, that makes it the general deduction formula. Okay, so I'll share this presentation, though it will be very small. You see if how was the gross income presentation that I shared? Were you able to find what you're looking for from that document? Was it easy to use?
Yes, for me it was.
Okay.
Yes,
All right.
yes, because you can even zoom it out. So, yeah.
Makes it easier. All right. So I'll just share this one in that same format. Then you can just go through this document. Then the question that I'll share is called. I've taken this from an old text 3701 exam. So the name of the question is Happy Repairs. So I'll share this one afterwards. Then you can try it as well. Then we'll discuss it together in class.